Okay, everyone, TGIF. How's everyone doing? Ingmar, AJ, Mike, Estelle. We're going to wrap it up. Hope everyone had a good week. K-Man, how are you? Steve, Blake, James, Brand, how are you? Hugo, Marcus, Ryan, how are you? You got a hole in one? Okay. Hugo, all right. All right, everybody. Linda Lyons, how you doing? I have a special treat for Stelios since he's here.
Hello.
Hey, you
Are you
feeling
gonna are
better?
you gonna sing?
No, it's even better than that. I'm going to show you uh, this. Can you see it?
Yeah, the big old cup and handle.
It's a log scale. So
Where does that
it,
measure?
uh, to 628,000, $932, I believe. I think we're there by next year or what?
Yeah, I think
Huh?
I think there's a lot of people exaggerating targets now, but
Yeah,
we'll talk about
we
we'll
got
talk about that. We'll talk about that.
we got to be getting close when you see log scales with 600K.
Yeah,
Anyway, it's good to have a fantasy, I guess. Who knows if it happens? We're like a third world country, so let's talk about what's going on here. Uh, Check out that the line that the S&Ps held yesterday. It's the overthrow line from the wedge. Isn't that amazing how it held it twice like that? It still fascinates me. Tagged it again, you know, had this line drawn before this hit, before this hit. So it's meaningful, right? That's the thing to get out of it. If we take it out, there's problems in the market. So I talked to some people. There are a lot of heavy ticks. We're pretty oversold. I don't think we're going to new highs. Maybe we could muster this, but I think this breakdown's inevitable. So we'll see what happens there. Um, why don't I just turn it over to you, Stell, and share with us what you want to.
sure thing, sure thing. All right,
There you
so let
go.
me take the screen. So a lot of things happening in the last week, and we have obviously PCE today, which is the Fed's preferred inflation gauge.
Yeah,
Excuse me.
420,
Sorry?
420, 420, 420, 420.
Yeah.
Trying it. Yeah.
Well, apologies for my voice and coughing. I'm still not well. I'm still on medication, but I am definitely better. Markets are actually what is I found really amazing is was Blake yesterday on the chat room when the euro dollar hit 116.55 says, look, this was my bias chart support from yesterday, from a few hours before when he did it, and lo and behold, the euro bounced from that level or from a few pips from there. So that was a really great call. But anyway, um, I'll start with yields as I always do. You know that I've had the view that yields I think are going lower. I am slightly worried because this seems like a little bit of forced breakdown. But the range I'm looking at is 419 to 423-ish. If we break above that, then I go back to neutral. Um, I still think, obviously, not my conviction is not as high as it was before, but I still think that this will resolve to the downside, and I also think that eventually QE is coming, and that will change the dynamics of everything. But for now, we seem to have bounced back the dollar and yields, and we are actually both the Dixie and yields. We are at a pretty critical level. You can see there's been quite a few lows here at 418, 419. There's a fib as well at 420. So, and also the 50 DMA. So it's very, very congested here in terms of um, resistance. So if that doesn't hold, then I go back to neutral and I will reconsider. But for now, I still think that this is a small bounce and then we go back lower. The Dixie is also bouncing. And this was something I drew probably a couple of months now ago. Excuse me. And that was my target around 95. But like you very correctly said, Dale, last week, too many people are looking at the 95, so it might not get there. I still think that's the over 50% scenario probability, but it's starting to look a little bit less convincing now. So I still retain my biases, but I'm a little bit cautious. And if we close above 100 or so, I think then I go to neutral on the dollar as well, and I reconsider. You talked about the S&P, and you looked at the 4-hour chart. I look at daily charts, and any way you look at this is not bearish yet. Yes, we have a little bit of a correction from the highs, but really, I mean, look at this chart. It's just incredibly strong still. Yes, valuations are high, everything's stretched. You have companies like Nvidia. I mean, price earnings are ridiculous. But the path of least resistance, I still think is to the upside, even though it makes no sense. So am I bearish stocks? No. If I was, I don't actually have. I only own a couple of single name stocks, but really very small percentage of my portfolio. So I don't. I consider myself to be flat stocks. If I was long, I'd still keep it and just wait to see some technical evidence of a breakdown. And really, for me to see, to turn bearish technically, you have to go below 63.50 or so. And then I say, okay, this is now we have a chance of making a lower high, and start getting a proper evidence of a turn. But for now, there is nothing for me. And talking about risk, we have to talk about cryptos. They have been a pretty good risk proxy, but now they're underperforming. Bitcoin has, and Ethereum, they've turned lower, and this is a pretty important area here, 107 to 109. That has to hold for bulls. We have also the 200 DMA approaching. I feel quite worried about cryptos, but given that I think that equity markets will most likely continue higher, I think they will kind of retain some of the correlation and at least go sideways. I don't know what event was going to make them move lower, but Ethereum has been doing worse than Bitcoin, and we have this inside trend line which we're touching now, and is trying to make some kind of move. But I don't trade cryptos. I've traded Ethereum once. Oops, what is that? Sorry. And I really don't want to be a part of this because I'm not. I can't say I really understand them that well, so I'm going to let them be. Metals, we have to talk about metals. Gold looking absolutely supreme still, and what really amazes me is that there have been absolutely no pullbacks, and that's in a move like this. If you zoom back and you go to a year ago, we were at 1800. We're 100% higher. There is no dip. I mean, there's one here in November 24. There's another little. I mean, there is absolutely no dip, and that's what makes me still very, very bullish in metals. There will be a correction, of course, but at the moment, absolutely no sign of that. And silver, well, it's broken out of this channel that we had for quite a while, and it's heading towards really the next level is 50. So the previous all-time high, which I think twice, 2011, and then in after the GFC, sorry, not 2011, back in the Hunt Brothers, and then after the GFC, was it 2011? I can't remember. Let's see. Excuse me. Yes, 2011. So that high, like you showed on your chart, is really the next target. I'm still running my silver longs. I have paired some of them. I'm taking profits on some, but I'm running the rest, and I have my stop at 42.10. And I keep raising it, and it just keeps going higher. So for now, I see absolutely no reason to turn bullish on any metal. I am still long platinum as well. Platinum has done really, really well because we broke out. There was a zone. We broke out, retested, then we're up to back to new decade high, I think, or so, 11-year high, and looking absolutely supreme. So still running that. My stop is 14.50 on that. I'm keep raising that one as well. And they say that one of the most difficult things you can do as a trader is sit on your hands and let a trade run without, taking it too early or, trying to tinker with it. So I am trying to sit on my hands and just take it a day at a time, moving my stops higher, not giving the trade room to breathe. Obviously, I'm not going to move my stop, $10 below on platinum or 10 cents below on silver. So just running that and see where that takes us.
That's a good
And
posture, Stel. I talked to a guy the other day and I said, how do you stay with positions as long as you do? He said, I fold my arms.
yeah, or you lock away your
It's a
laptop.
good posture,
Yeah,
just with your just folded arms, meaning
yeah,
you're just, watching
yeah.
it.
And
Yeah,
I've said this before. The guy who taught me how to trade years and years ago, over 25 years ago, he said to me that trading is probably one of the most difficult jobs in the world because your natural instincts are exactly the opposite of what they should be. So when a trade goes well, your natural instinct is to, oh, take the profit, take the profit. And when a trade goes badly, natural instinct is to say, ah, let it run, it's going to return, it's going to come back. And you should be doing exactly the opposite. So,
yeah.
yeah.
Okay. Nice
Okay,
trading. Nice
that's
work.
thank you, thank you. I mean, I get lucky sometimes. I try to run with the good trades. I try to cut the bad trades.
Well, you've been a great ambassador and advocate for being long silver for many years now, bro.
Well, it's finally
And
performing, right?
yeah, yeah. Well, congratulations on that, and I'm glad you're on the road to recovery. Why don't you go lay down now?
I'm here. I'm here for the numbers
All
for
right.
as well. So I'm gonna pass
All
over the
right.
number, the screen, and I
All
don't know
right.
if Ryan is here or Kay or whoever.
All right. Thanks, Stel. All right. I guess I could grab him before I turn him over to
Oh,
Blake.
or
So,
I can take it, and
oh,
you can
no,
just
go
talk to
ahead.
the
Yeah.
boys. So I'm sure
Okay,
you
go
want.
ahead.
Yeah. All right.
All right. You got him?
Yep.
Okay. So, good morning, Ryan and K-Man.
Morning, sir.
Hey, Batman and Robin.
Morning.
Uh, so, you guys, should we be patient for, say we're bullish a dollar? And it's really had a pretty nice move. I mean, it's accelerated. The dip that it gave early in the week was not even halfway back. I think it was 38%. Euro gave the best pop to sell into. What do you do now? You just sit and wait for things to reset to try the long side of the Dixie.
Well, you don't chase it up here,
Yeah,
definitely.
don't
That's
chase.
yeah, don't want to be chasing it up here. If you think you want to be long dollars, you've got to wait for a decent pullback
Okay.
and
Yeah.
see if you get one.
Yeah.
But there's lots of things going on at the moment. We've got a bit of risk going on with Europe and Russia. We've got data coming up.
What's
Um,
happening with Europe and Russia?
just
Mm,
as Europe's finally got off its arse and started to push back against Putin and all these little flyovers and incursions and all that, to the
Okay.
point where they've got the green light to shoot down stuff over their airspace.
Yeah.
Whether they do that or not is another question, but it's definitely a step up
Yeah.
in
I mean,
rhetoric.
I've seen reports that these are, they're sending in cardboard drones. That, that this is, again, what Europe wants. You know what I came across yesterday? And I was thinking, God, I wish I could call you guys, but you were sleeping. It seems that the trade deal between the U.S. and the Eurozone um, is falling apart.
In what way?
That's what I saw. That the lady who runs the Eurozone said that they couldn't possibly meet what they shook, achieve what they shook hands on a month ago. Have you read anything about that? It
Uh,
seems like we don't have a trade deal with Europe.
I don't know. I don't know. I don't know about that. He dropped a load of new tariffs on everyone last night.
Hmm.
So if you're looking to furnish your house, Dale, you better get down the shops tomorrow because you got 4 days before tariffs go up on sofas and cupboards and all that sort of crap.
Oh, I just have a bunch of beanbag chairs all over the house.
Or they should go to
All right.
DFS. They should go to DFS, which have like a 90% discount all the time, don't they, Ryan?
Yeah, exactly.
But Stella, have you heard anything about it, or Blake, about the trade deal with Europe?
uh, I
Looking
didn't, I'm
shaky.
afraid.
no, I haven't.
Okay. All right. Well,
Celius,
then,
did you?
No, I did not.
Yeah.
Okay.
Vonder Leet. What is her name?
Nayan.
Yeah. Anyway, no, I haven't heard anything.
They're saying it's one-sided, so many billions of dollars a year that they were going to pay the U.S. And I just saw the story that they're admitting they can't fulfill their end of the bargain. So there's no deal with Europe. Just something, we got a lot of people here. We work for you all the time. Someone text us the answer. Go do some research for us. All right. What else is going on, Ryan, into the weekend that you're thinking?
Yeah, well, we've got a few pairs on the go. Look at
There it
dollar yen.
is.
I know you like to look at dollar yen. What's he in now? He's in cable. I've got to work out what he's in. Yeah, so we've had a couple of big breaks up in some dollar pairs. Dollar yen's had that breakout above that 148.80s that we've been stuck at for all that time.
152. 52 is my target.
Yeah, we could get there. We could get there. It's got to do a lot more to get out there. I think we can get towards that prior high 151.80s. 150.80s. I think that's possible. The Bank of Japan, they got some bad news. I compared their watching data to playing snakes and ladders. They climb up a ladder, then go down a snake. They had real wages revised to negative from positive, and then they saw a bit softer inflation numbers. So they were strolling towards a hike, and now they're sort of stumbling towards a hike. But that didn't really hit dollar yen at all much. We keep an eye on that for risk. But what the main point I've been making about all these dollar moves, you've got to have one eye on the wider picture. If you take something like euro dollar, and I'll wait for Blake to catch up with that one.
Sorry, getting there now.
He's getting there. If you look at euro dollar on the daily, for example, we're still 400 pips away from the 38.2. So you look at the wider picture, a lot of these dollar pairs are, they're still in just minor pullback mode. Still a long way to go before we start testing the trend of dollar selling this year. So I don't think we're out the woods yet, just based on the moves we've been seeing the last couple of days. Yeah, look, big old trend this year.
Yeah. Okay. So I'm in the camp right now, even though I'm looking for 102, that it's a bear market rally. But 102 could mean 110 euro, right?
Yeah, it could do.
Sub 130 pounds, 62 Aussie. So yeah, I'm just sitting on my hands waiting for, my arms are crossed. Waiting for a rally in some of this stuff.
But if you're seeing that, something has changed. Either something's gone horribly wrong in Europe, or the US is exceeding all expectations, which, looking at the data yesterday, was very strong, and where's all the recession callers gone?
How about interest rate differentials? If yields get through 420, 10-year.
Yep.
How about all the flyovers that are happening geo-wise with Russia? And I want to thank Lindsay for trying to explain what's going on there. And Forex gals. So I wasn't hallucinating. Thank you very much. So we don't have a trade deal with Europe. No one's making a big deal out of it.
What's that? Let me see.
There it is, one-sided. Stead. It hasn't even hit because I know if it hit the news that you guys would be on top of it. So it's not getting a lot of press.
But they've already been put forward. These people have been put forward to negotiate.
This is not this what you show there is just
opinion,
just an opinion piece. The other one that Forex Gal posted earlier, that is talking about the reaction that Europe has when Trump threatened to slap 100% on pharma, because pharmaceuticals have been negotiated according to the EU, and what I think is true, have been negotiated in the original framework, and they should be limited to the famous 15 or whatever percent. So that's the reaction to it. Yes, that came out after Trump threatened to slap 100% up to 100% on pharmaceuticals.
Yeah, and the thing on negotiations, yeah, it's got to go to the state level, but there's people who have been negotiating on behalf of all the states already. So it's not like they're just off the cuff doing their own thing. Sefcovic and the likes, they've all been put forward to do this negotiating. So they have got a mandate to do so.
Yeah. So it's I don't know, it's making me bipolar. Deal, no deal, deal, no deal, deal, no deal. Okay, so going into the weekend, thanks a lot, Ryan. Came in anything, some wisdom you want to share with people?
Wisdom, not really. I would say risk management, maybe, because
That's wisdom. That's wisdom.
there's a lot of this. We're talking in length about it on the flow show this morning, because there's a lot of happening between Russia, NATO, Ukraine. Yesterday, Zelensky was talking about he wants something to really scare Russia, and then Eurozone, Europe, etc. And it's really getting to a situation or a potential of having like kind of a
war.
weekend risk, and so I decided just to go. I had a few, you can call it pseudo, even though the yen is not really a risk currency these days, but I really closed what I would say are risk positions ahead of the weekend, just to be on the safe side. And if nothing happens, I can always take them back and come Monday. For the rest of the day, we are trading value date end of month, so we may see a bit of US corporate activity if they need to do maybe a bit of shopping dollars, and then we should be start to trade the real end of month, end of quarter afterwards. So we may see a bit of a yo-yo action for the next 3-4 hours or so, depending on what, as I said, what the US corporates want to do. So I am running at very reduced risk for now in my books, and I'm room to roam.
Okay. All right, Blake, got about 7 minutes if you want to prep the community with your experience, warrior. So what are you doing? What are you doing in front of this number?
Actually, I'm not doing much of anything. I've taken off a lot of my positions as of yesterday. One of the things that Ryan and K-Man have just been discussing the last couple of days is corporate month end and then month end flows. I mean, so today is value date, right, K-Man?
Yes, sir.
Yeah, it's value date. So there should be potentially some dollar buying coming in. And what I'm hoping and trading, just hoping that you might get some pushes to certain levels is I hope some dollar buying comes in today and actually pushes the euro a little bit lower. And thank you, Stelios, for recognizing we were talking yesterday about the bias chart 1655 level that was out really early yesterday, about 24 hours ago, and the euro basically fell right to those levels, and you can see we're bouncing, we're finding support here. I mean, technically, I would argue that this is a bear flag pattern that's developing, and so if we get some corporate month end, maybe dollar buying, pushes the euro, lower towards that 618. If we could see the 116 level, that'd be great, but it seems highly unlikely at this point unless the PCE data comes in really strong. I mean, and how many of you guys are expecting strong PCE data at this point? So we'd have to have a really, really hot data, more so than expected, more than Powell had given us an indication of during the FOMC, and then on top of that, some strong corporate month end. Then you look at the calendar as we go into Monday, Tuesday, most banks are reporting and estimating that there's going to be some dollar selling. So should we get, some dollar strength today, and it looks like this, then maybe we'd look for a reversal sometime into early next week. All in all, I think we're kind of mid-range. So you gotta finesse these levels. These are levels where you can't really commit, aggressively to on most currencies. And no one like here's the euro, not too far from the 618 retracement. That's one thing that we should note. Sterling is sitting on really critical support. I mean, that's major support right there, around the 618. The Aussie dollar is on the 618 retracement. The Kiwi dollar is almost at a major confluence of 127% extension. You can see it right here, 127% extension, 618 retracement long term, 161% extension of the last gasp higher when it made that move higher in July. So this is major confluence, but we're
There's
not
a trend line
bouncing.
as well there.
Well, I'm sorry.
There's a trend line as well coming over there. You know that little circle that you put there?
Right
Put
here.
no, the next one, and then the next, yeah, and then draw it over the next low, and you will see we're nearly there too. So it's it's all happening there in the Kiwi.
Yeah, it's all there, but God, you see what the Aussie Kiwi's doing. I mean, you can argue that maybe the Kiwis, it's about time that we see a little bit of Kiwi strength come through. But I mean, it's trading heavy. I mean, if it's such an attractive area to be long down here, I don't know how many people are trying to take advantage of it. I'm almost more keen to making sure somebody steps out in front of it ahead of me, and then I'll just jump on the heels of them and then just play it as more of a squeeze play if it could break higher from there. That's kind of how I'm looking at it now. But yeah, I mean the Kiwis around some really key levels. You can see the Swissies pushed up against some resistance, and obviously with all this European news, I mean, Europe is pressuring Russia right now, and this is like a full court press between Europe. We'll just call all the West and Russia right now. And the question is Putin gonna roll over, or is he gonna push the
No
envelope
way.
a little bit more? Yeah, I mean I'm with K-Man yesterday when that headline came out. I took my Euro Swiss off and my Aussie Swiss. I took both of them off for a loss. I'm like, I can always get back in. That's the thing about being a trader, is we can always get back into the markets if things settle down. But shoot, I don't know if I want to hold anything over the weekend that is associated with risk with Russia and the West, and you got the war of the words with Ukraine, and Trump emboldening Ukraine this week. I don't know. It's a little crazy. Anyway, I'm gonna get us ready for PCE. We got less than a minute. The dollar index is to the left. Yields are right in the middle. You got the S&P right here. I should probably put on gold, but I think gold and the dollar are going to be just inversely related when this release comes out anyway. Go to Forex Analytix. By the way, you guys, there is a major sale going on till the 30th for funding if you guys are trying to get funded as a trader. So make sure you check that out. I'm going to open the data flash here, move that out of the way, put us back on these charts, and let's get ready for the data that's coming out. So that data comes out in approximately 20 seconds. So yeah, I'm kind of standing aside right now, seeing what some of these flows bring us here over the next couple hours. And then, as Ryan pointed out earlier, the Ryder Cup. We'll go into holiday mode here in a couple hours. So Canadian GDP is out, a little stronger than
As
expected.
expected, as expected.
0.9 year on year.
Yep,
2.9 as expected. The core.
little
Plus the
weaker.
spending still a tad better, just a
Yeah.
tad.
Yeah, prices just a tad higher. I mean, The dollar is firming up a little bit. I mean, a little. I have it on an hourly chart, just a little bit here. But man, I don't think it's much to rock the boat. I don't think I want to do anything at this point.
Powell gets it right again.
Yeah, but he was off last time,
Well,
wasn't he?
he's 5 out of 6. It's still a
All
good
right, all
record.
right, all
I'd like to have
right.
that trading record.
That is a good trading record. Yeah, I mean, I don't know. I mean, stocks are liking it. We're seeing a little bit of short squeeze into the weekend. And one thing, Dale, I do want to point out, and I know we posted this chart here. I'll just go this way on the S&P. Um, yeah, here we go. Let me get over to, whoops, not there. Here's the S&P. I'm sorry. You know, we've only pulled back to a 38% retracement. I mean, that's of the September, the whole month's move. We're only at a 38% retracement. We haven't even started making lower lows. I mean, and I'm short. I'm talking to you as being short equities right now. I mean, let's face it, this is still a very shallow retracement. Have you listened? I know we have Luke Groman on the Face show, uh, here, and I was actually listening to him on a macro podcast, Dale, yesterday, and he believes stocks are going so much higher sometime this year, like in the next year, 9 months to a year. He believes that we have no other choice than to do yield curve control at some point, and when we do that, you just have to buy everything again. So I was listening to that podcast. I was like, that's an interesting point of view. I don't know if you've
Yeah,
next time you have him on, you should have that conversation with him.
I'll try and remember, Blake.
Yeah, it's one of those things. I heard it yesterday. It was on oh God, I'm trying to think of the macro podcast that it was on. But yeah, it was a really interesting one. And
All I know is 6705 was a great sale, and I still have some. So
yeah,
we'll see.
yeah, hey, look, I'm short with you, Dale.
Well, and I'm not long-term bearish either. I'm figuring, if it's really nasty, 6,200,
Yeah,
six
that's
thousand, but it could hold at 64. But I don't think the fact that we've hit that line twice tells me that they keep knocking on the door. The next time it'll take that low out, and then we'll see how deep it is. But you're right.
yeah.
Under yesterday's low, which was right around the same low as the Fed day, is real critical. That's to me the bull bear line, 65.70.
Yeah, I agree. And again, it's a 38% retracement.
Then
So
you have a bigger head and shoulders.
yeah, yeah, and actually this head and shoulder pattern realistically didn't complete yet. So I mean, it completes somewhere down here.
Well, I
But
mean, couldn't you have a neckline against those two lows, and now we're putting in another shoulder.
yeah, potentially.
That
Hey, here
anyway,
comes
we,
that
we
dollar. By the way, I'm
uh,
sorry. Here comes that dollar buying, guys. Just kind
Have
of
you got
coming
a
in.
guest today, Dale?
what's that?
You got a
I
guest
do.
today?
I have Danny. I'm trying to get Danny to accept the promotion. Danny, you won't have to work here or anything.
Danny,
I'm just
Dan,
Danny Diane. Yeah.
Diane. I'm
Okay,
up.
here we
I'm
go. Do
promoting
you
him
know?
now.
Do you know his work? Because Danny prepared something. I read some of Danny's stuff, his macro musings, and the topic today, since we were talking about it, is Danny's going to do his version of Kramer of the Fed. Danny believes that the Fed made a policy error a week
Oh,
ago. So he has a whole presentation lined up. So welcome,
great.
welcome, welcome back, Danny, and tell us how Paul blew it again.
Hey Dale, thanks for having
Hey,
me on. Just
it's
got a
great
lot of
to,
data, so
yeah,
glad we have a lot of people on the show. Great, good to be back on. So now that I have the ability to share, let me get that presentation for you.
okay,
Okay, that
yeah,
should be
we've got
visible,
it.
right?
Yeah,
All
we've got
right.
it.
Okay. The gist of it is, we have a very complicated set of policies from the Trump administration. And, the big ones have been obviously the immigration story and the tariff story. And if you look at the labor market, this is before Trump, where since 2022, when the labor market recovered, its losses, we've had a substantial amount of job gains, 6.5 million job gains, but we've also had far fewer than that in labor force gains. And so labor supply has been shrinking, has been growing less than labor demand, for quite a while. But if you look since the beginning of this year, the labor force has actually done a complete zero. And a big reason of that is the immigration story. So the chart on the right is my estimate of potential growth for the economy. And you'll notice that on, for a couple of years, we were as high as 3%. That is actually not a normal long-term pace for the US economy, but that was as a result of the loose immigration policies from Biden. Temporarily, potential growth was stronger, which is why when we were growing at 3% in 23 and 24, we didn't overheat. Typically, you would think if we're growing well above potential growth, we would be overheating. That's not what happened. But as a result of Trump's policies, the reversal of that, not only stopping that immigration flow, but reversing it in a big way, about 1.6 million foreign workers have left the labor force. We're down to like 1.5%. And the reason this is important is the Fed cannot do anything about this. Rate cuts cannot do anything about the lower labor supply. For example, this is my model of the monthly break-even rate. Powell himself estimates it's anywhere between 0 and 50. I have it about 30K a month. You'll see like under the Biden years, this was 100 to 150 at various points in time. It has collapsed to 30K. So what does that mean? It means it only takes about 30K jobs a month, if this is accurate, to keep the unemployment rate stable. And so the Fed is sitting here saying we need to cut 150 basis points. You don't need to cut 150 basis points. The last 4 months, we've grown 22K. So a little bit below that potential, break even, but not substantially below that break even. And the fact is they really can't do anything about the fact that the break even is this low. If they cut too much, and I think they already have cut too much, then this could easily overheat fast. And I think they're not recognizing that. This is from the San Francisco Fed on the right here. And this is basically looking at the labor market from states. So bottom-up analysis. And they say when 30 of 50 states, 60% of states have rising unemployment claims, that has been a good recession signal, going back, almost 80 years. And actually last year we got close. We got really, really close, as you can see on the line there. But look where we are today. We're basically at zero. So, when they look at the labor market, it's not hot. I'm not sitting here saying it's a hot labor market, but it looks like they really are not in control of what is driving the labor market. And they don't recognize that it really won't take much for the unemployment rate to fall at any meaningful acceleration in job gains. And it would be very hard for it to rise substantially given the supply story. The other reason I say rate cuts are, here's my kind of theme, is rate cuts are the wrong medicine. If you look at the corporate sector, you have record profits and a share of GDP. You have net interest payments have collapsed, 45-year lows in net interest payments. If you, take your favorite AI, go and sit and, ask them how many companies on S&P 500 earnings transcripts have said the cost of capital is too high for them to expand their business. There's not one. Nobody has said this. Nobody is complaining about the cost of capital. So why the Fed is looking at a situation of the corporate sector and saying, yeah, they need lower rates to hire people. It really is not the case at all. Rate cuts are the wrong medicine. We'll continue with that. Look at the consumer. What is their number one concern? I don't see job security in here. I don't see tariffs as a big deal for them. You know, they don't really care about it. It's inflation.
Yeah, sure.
45% inflation.
Yep.
By far, this is the biggest thing that everyone is worried about. And so rate cuts to fight inflation, is that how we're doing it? That doesn't really make a lot of sense, right? One of the ways that I like to look at this going back, 100 years is, we just got PCE data, and I'll rerun the numbers after. But when you look at monthly consumption and you look at monthly inflation, how much of consumption is simply inflation? And we're at 50%. That's very, very high. 60% has tend to be, when bad things happen. And we're not that far from it. And rate cuts could potentially send us up there, right? If it causes another impulse to inflation. And so I think, again, they're just missing the real story of what's going on here. Last part on this is, if, and I have to admit, I've been guilty of this. For the last few years, we saw really low consumer sentiment. It didn't really make sense. The unemployment rate is low. The stock market's high. GDP is strong. For the most part, people like me have ignored this message, but I don't think we can ignore this anymore. They are clearly telling us something, and we're not listening. And, I think the chart on the right is really telling the story. 70% of consumers think that their incomes won't keep up with inflation. And so, and you can see how that surged to start this year, right, as a result of tariff policy. So again, how are rate cuts going to help this? Rate cuts are not going to help this. Rate cuts are going to create a new source of inflation, monetary.
Exacerbate it.
It's just going to exacerbate it, right? And so they're not reading the room, and that's why I keep saying it's the wrong medicine. Part of the reason consumers are so frustrated is that most people, if you ask them, just ballpark it in their head, real world inflation is higher than CPI. And yeah. I attempted to model this in a few ways. One is, before 1983, they included housing transaction costs and interest payments and things like that in the shelter calculation. There's good reasons they took that out. I'm not saying they should put that back in, but it is undeniable that that is what consumers feel. And if you actually model that out from 2020, you have 20% higher inflation as a result of using that old methodology. Again, that is what consumers are actually feeling. On the right is adjusting.
It's what they're not feeling, paying. Struggling to pay.
It's pain.
Their housing's 50% of their disposable, at least, isn't it? On average.
Exactly.
Okay.
But it's not just housing. If you look at this, the chart on the right is healthcare. According to the BLS, healthcare is CPI has actually stopped growing for the last 5 years, has gone flat. Nobody believes that. Nobody would, attest to that in their real life. What I did was I incorporated the fact that healthcare spending is growing 7% year over year since 2020, and we get another additional boost to inflation of about 2%. Food prices are also not accurately represented in inflation. If you do all those three adjustments, CPI would be double what it is. And that actually explains this sentiment being at, GFC levels, because it's substantially worse than what CPI is saying. Now, again, I want to say, I don't think the Fed needs to come in and, change the CPI basket to be more reflective of any of the things I've said here. That's not my job to say that. But what I am saying is, I think it's hubris for them to ignore this. When, they say, 3%, it's high, but it's not catastrophic. But consumers are telling you it's substantially higher. And I'll show a couple other metrics of that. Every indicator for inflation is pointing up. Here's ISMs, this is the business surveys, here's import prices coming from the dollar. All of these suggest we have a major set of inflation, coming ahead. And the Fed, in response to that is let's cut rates. Inflation expectations.
So they
and I
really
think this is,
they baked in stagflation here, Danny, for sure. The
they
pie
did.
is cooked. That's the
I
point of
think
this.
I think we may get something worse than that, but I'll leave that to the end, and I'll after I go through it all, and I'll give you the conclusion.
Okay.
Inflation expectations. I think this is possibly the most important set of charts that I'm going to go over, and I'll explain why. Clearly you can see they're very, very elevated. In 2022, as inflation was clearly out of control, 9%. An interesting thing was the University of Michigan inflation expectations was around 2%, consistent with 2%, 2.5%. And the reason it was down there is, the Fed had 40 years of credibility, and the Fed also responded in 22 pretty aggressively. And so they had the benefit of that, of inflation expectations reflecting their credibility and not reflecting where inflation was. Well, if you look here, that's clearly not the case anymore. And the Fed is ignoring this. In fact, I found Powell's comments last week really, really bizarre because he was asked, what's the big worry on inflation? And the worry on inflation is that, according to him, after 5 years of being above target, inflation expectations get unanchored. Okay, I argue they are already. But even, what he says is when that happens, businesses feel more comfortable hiking prices and households feel more comfortable asking for wage increases. Okay, how do rate cuts not directly contribute to that, right? How do rate cuts not give businesses confidence that they can raise prices further? Rate cuts are designed to raise demand. So clearly, whatever businesses are doing in response to tariffs that may or may not be transitory today will be less transitory because you cut rates. Like it just doesn't make sense. And households, they're directly trying to stimulate the labor market. Well, what do you think will happen if the labor market tightens? They'll ask for higher wages. The very fear that Powell has is what they're enabling by cutting rates, which doesn't make sense with their reaction function.
So, all right. Well, from the point of view of an economist like you, Danny, but could there be agendas that are different than mandates
Yeah, I
as
mean,
to the reason?
we've seen the White House, attack the Fed. Their claim is interest payments would be lower. Obviously, they want housing to improve, and understandable both of those. Although, of course, the Fed is supposed to have their own mandates. In fact, that's kind of what this slide alludes to. I found there's a lot of historic academic studies on attacks on Fed independence, and the most interesting thing from all of these studies, including this one, is GDP doesn't actually improve. So the White House thinks GDP will be better by the Fed cutting rates. It actually, historically, attacks on independence do not improve GDP. And I thought that was interesting. What they do is they raise inflation, and not only raise inflation, as you can see, it's for many, many quarters. These are months, right? So for up to 3 years impact to inflation as a result of attacks on the Fed. So I think the White House is just completely miscalculated, and they think there's a free lunch here. What this is showing is you get the bad stuff and you don't get the good stuff. If you got the good stuff alongside the bad stuff, okay, maybe you just make a trade-off. But here it doesn't look like that's the case. I've spent a lot of time modeling the tariffs. I used a very famous model. It's called the Gordon Triangle model. It was very famous in the 1970s. I'm not going to get into it, but if you use the Gordon Triangle model in 21 through 24, obviously, with the benefit of hindsight, we have all the inputs to put in there now, today, which weren't as easy back then. But if you have the right inputs, as you can see, this model does a very good job on both demand and supply inflation. And here's when you put in tariff assumptions, effective tariff rate of 18%, and things of that nature. Here's how it models tariffs. And I don't think anyone is ready for something like this. for a move up to a 4.5–5% range that's there through 2028. If this, model is accurate, nobody is ready for this. People think it'll go up into the 3.5s and then come back down next year. But if we have something like this, then I think we're in big trouble. And that's why, again, I look at the Fed and, their response to this is to be extremely dovish. And so as a result, break evens have moved higher, inflation expectations from the market, not a lot, but they've moved higher. And real rates have moved substantially lower. Real rates are, substantially lower and below what even the Fed's estimate of neutral is. And so that's just way too stimulative, Dale. I'm a big believer in financial conditions being important. I've built models and frameworks on financial conditions to show their impact on the economy. Here's, my models, what they're saying for GDP and inflation. They're on par with 2021. Put that into context. The Fed is, they talked about financial conditions 3 years ago. They don't talk about it anymore because they know that it's gotten away from them. And, the equity market is a big part of that, the dollar as well as, bonds. And you can see that we have very sharp impulses to GDP. Well, and I'll show you the results. And then we also have very sharp impulses coming on inflation. And so they're not realizing that their too dovish stance is impacting inflation already by a big degree. We're already seeing financial conditions impact the economy. Yesterday, we got this week, we got a 20% surge in 1 month in new home sales. We'll see if that, isn't revised, but, is a substantial acceleration. We've seen a 75% surge in mortgage refinancings in 2 weeks. So whoever had a 7% mortgage, was able to lock in a 6% mortgage.
They've been waiting for that. They've been waiting for that for a long time. You knew they were.
They've been waiting for that. That frees up income for them to spend on other things, right? And we're already seeing consumer spending, which is driven by the wealth effect, the equity market, which is up 40-odd% since April lows. We had the fastest 3 months of consumer spending in 3 years. For people who are saying, tariffs are going to crowd out spending, well, the most discretionary category we have is restaurants, right? If you're struggling to pay your bills, you're not going out to restaurants 3 times a week. You're eating at home, or you're eating, fast food. You're not, if you're struggling to pay the bills, you're certainly not going out to restaurants multiple times a week. We had the fastest 3-month run rate in restaurant sales. Again, going back, over 2 years in this chart. And so what I'm concerned about, the real consequence from all this is, we hear everyone talks about run it hot and, we want to inflate the debt. And that's all nice and well, but I think the real issue is the wealthy can handle it and the lower income brackets cannot. And, in 2021, they could because wages were 7%, we're growing 7%. There were the cash handouts that Biden gave everyone. In 2021, the lower income groups were doing very well and they could manage with the inflation, even though it was obviously very frustrating. In this environment, what we're seeing is, incomes for the higher groups are accelerating, incomes for the lower groups are decelerating, and you see that reflecting in spending. And so you have the higher income groups who are doing fantastic because their equity portfolios are flying, right? Their wealth is going up on top of their income. But the lower income groups are the ones that are complaining about this. And they're the ones who are being squeezed. And so what I'm very focused on is, do we have a breaking point to all this? This wealth inequality story, the youth unemployment situation, the youth, surveys where they feel, the American dream is out of reach, housing is unaffordable, all of the things that they think, capitalism doesn't work for them. Do we have a potential breaking point of maybe even like social unrest if we
I was
cause
going to
another wave
ask.
of it.
It's going to be more of
That's what I'm
social
concerned
unrest
about.
than financial,
That's
right?
what I'm worried about. So, you know, in the markets, where I come back on all this is the Fed is inappropriate. They're inappropriate with their policy. And as a result, financial conditions are very stimulative. It's hard to be, you know, bearish equities
Yeah.
in that context. It's hard to be long the dollar in that context. Although I would say, I think tactically in the short term, you know, we could have some more of those. Like, you know, we could have a little bit of equity pullback and we could have a little bit of a dollar rally, but it's hard for a sustainable dollar rally if the Fed is going to continue cutting into this. Now, at the same time, from, you know, the data that we've been getting is extremely strong. Like what we got yesterday, what we got with retail sales last week. And, you know, even today, early morning, we got very strong spending and income numbers. We'll have to see, is the data going to pull the Fed away from all this? Because, you know, what did I show here? You know, housing is improved, consumer spending is improved. The last shoe to drop would be, you know, a better job report or two. And if that happens, the Fed backs off, right? So that
Hey,
is what I think.
Danny,
Yeah,
this is Blake. I wanted to ask you a
Blake.
question, and nice to meet you, and great presentation thus far. If everything you talk about as far as inflation and it's too hot, Fed's inappropriate, and you're talking about subject matter that I believe is on point. I hear a lot of people discussing a lot of the same inequality, you know, the wealthier carrying the load and everything else. But let's go back to the Fed really quick. A narrative that isn't discussed a lot today, which was a couple years ago, is going back to the early 70s when I was a kid, and Dale remembers this, when the Fed started to cut rates. The economy was running too hot. They had to actually start rate. They cut rates and then they had to start raising rates again. We were, in retrospect, in the middle of a recession, or you know, going into a recession in the early 70s, and it was during the oil shock. They had to raise rates again. Do you think that's what the Fed's going to have to do? They're going to have to pivot, and you know, to cool off the economy if inflation isn't calming down. The employment picture is still, you know, relatively strong. You know, economic data continues to run fairly hot. Is the Fed going to have to raise rates again versus cutting rates where the market's pricing it? Because that's where that disparity, that reversal of expectations is what really moves the market, which we all live in. But is that what we're going to be facing moving forward?
Will the
I
Fed
think they
reverse
will.
course?
I think they will have to, but the really hard part is, will they? Because they will be politically captured by Trump.
Yeah. Yeah.
And that's the
Right.
challenge, you know. So I mean, I think, you know, the candidates being proposed for Fed chair, like Waller, you know, or Warsh. I think if inflation really is, you know, 5%, they will be hawkish.
Yeah.
And but I don't
Agreed.
know if instead, if they put someone like Steve Moran, if it'll just be a complete cartoon show, you know, a
I
clown
mean,
show.
like Arthur
And you know
Burns.
what he did with his dot plot and how he justified it in the last week. Anyone who's followed him on Twitter for the last few years knows that it's a disingenuous view. Like, it's not his views are strictly political. They're not really economically driven, because he's done a full 180 on multiple topics, and he's basically just trying to find data to back into what Trump wants. And
Well,
so
and
if
that's why
if he's Fed chair,
nobody from the governing council jumped on his bandwagon. I mean, it was obvious when he was the only dissenter. If he really had a case, they would, and it was more politically driven. Yeah, but the Fed loves its independence here. I mean, you know, wouldn't you agree with that? They're fighting
yeah,
for
but
their
they're still
independence.
talking about cutting. They're still talking, like, okay, again, go back to this. Powell himself knew that the break even is between 0 and 50K. So even if it's at the higher range of what I estimate, you know, I say 30, but he says, let's just say it's at the higher end and it's 50. It really wouldn't take much for the job market to get back to those type of levels, right? Like, you know, the markets are doing well, the GDP is quite strong, you know, labor market is the one thing that isn't, you know, okay, you give it a little bit of a boost, you know, that's fine, but they're still in their dot plot projecting cuts all the way to 3%. And so, you know, that's from 4.5, that was 150 bips of cuts. And, you know, clearly you don't need, if your break-even level of employment is that low, you don't need that much to get it to a little bit better pace than what it currently is. And so I think that's the real, you know, challenge here is I'd like to say the Fed would be responsible in that situation that you're outlining, in the situation I'm outlining, but I don't know that they will be. You know, we really don't know that. We know for sure if Moran is the chair, he's going to be pushing for ridiculous action. You're right. Maybe the committee doesn't go along with it. We've never seen something like this where, actually, we did once. Volcker
Arthur
had
Burns.
the
Arthur Burns.
we had, well, the committee went along with Arthur Burns, but with you know, Burns made mistakes, but the committee went along with it. There was one point where Volcker wanted to tighten and the committee did not, and Volcker pushed it through. So do we have a situation where like Chair Moran pushes rate cuts as inflation's going up? And, you know, we may have a situation like that. No one really knows how that plays out next year. But I do believe that with financial conditions as easy as they are, that the impulses to the economy are very strong, that we're more likely to see unemployment rate go substantially lower than substantially higher. On the middle ground, could it go up another 0.1? Yeah, I can't say it can't do that. But I think we're more likely to see it go substantially lower than go to 5% per se. And I think, you know, the issue is, again, they're projecting a lot of rate cuts, and that themselves doesn't seem appropriate. If they had come out and said, you know, we're doing one cut, it's like he did say insurance cut, whatever, we're doing one cut, but they didn't have a dot plot that showed 150. I think, you know, maybe that would be a little bit more reasonable for as a reaction function. But I do think they're going the wrong way. I just don't know if they'll have the stomach to reverse it, you know, by next year. It's really hard to bet on that. It's really hard to say.
Could the market reverse it? There are those guys, those bond vigilantes. Could they make the Fed reverse by just not buying treasuries? And is the market going to be bigger than what the Fed is doing with rates? If they see the same thing, huh? Go ahead.
So far, we're sort of paralleling what sort of parallel to what happened last year. They cut rates, and since then, yields have gone up pretty consistently. And equities have started to wobble a little bit over it. Not a big correction, 1%, but you know, they've started to wobble a little bit over it. And you know, I think what we've seen in, you know, again, I'm going to go back to financial conditions, which is a big focus for me. I call it the financial conditions loop. If you follow me on Twitter, I talk about it all the time. The first shoe to drop with financial conditions is housing. It tends to react within weeks. You know, the purchase index, the refinance index, you see a reaction within 2 weeks of a sharp drop in interest rates every single time. So housing is first, and then within a couple months, you get something like a pop in sales. You don't usually get this big a pop in sales, but you usually get, you know, some kind of 5 to 10% pop in housing transactions. The next thing that you get is via the wealth effect, you get higher consumption. And then with a delay, what you get is, you know, better labor outcomes. And then you get inflation. Inflation lags. So, you know, when I look at financial conditions as loose as they are, it seems like if we get a decent payroll report, let's just say we get a 75K payroll report, that is well above the break even. The unemployment rate would go down a touch. If that happens, given all the other data we've had, bonds could easily go back to 450, 460. I'm talking the 10-year. Easily could go back there, and that could hit stocks.
That's my
right?
target.
Stocks.
Yeah.
Yeah, it could hit stocks. The dollar would rally. You know, maybe we would have something like that. Every single one of these episodes, equities have gone first, bonds have gone last. Bonds have gone last. Bonds wait for the data to actually come in strong before they react, whereas equities have tended to go ahead of the data. Equities have, you know, April 10th or 11th or whatever the bottom was, have never looked back. Right? They have never looked back since that point. They have just gone straight up since then. They clearly, you know, said the event is over, the uncertainty is over, the impact on the economy is over. I'm gonna come back on the not sharing anymore, but and they've, you know, they've never looked back. It's bonds that are always late to the party from a financial conditions standpoint. So I think it's very possible that we get a major bond market correction out of this because we just overdid it on the rate cuts, as we have 5-6 times before the cycle.
Okay, Danny, great presentation. I hope millions of people hear this. You got to get it out. You know, I've heard people talk about the Fed making a policy error, but have never seen it laid out this way with all the different factors. You're definitely an economic intellectual, and you made it simple for us to understand. Appreciate it. That was great, bro.
Thanks, Dale. Thanks for having me on. It was great to be on again on your show. I love it, and you know we'll have to do it again soon.
All right. So, best way for people to, you know, stay in touch and follow your work and get your, you have a letter, you have a Substack. What's the best way for them to go about that, Danny?
Sure. So my Twitter handle is DannyDiane5. You can find me there. I'm posting sarcastic comments almost every day. Hopefully you find them entertaining. And in the link in my bio, you have a link to Macro Musings by Danny D, where I do, you know, detailed analysis like we just went through on a regular basis. I have weekly notes. I also have very deep macro thematic notes. As well as trade ideas and everything of that sort. So check it out, and you know, look forward to the dialogue there. Thanks again, Dale, for having me, and I hope you have a great weekend.
My trading warrior brother, Danny Diane. Follow him, make him part of your intelligence gathering. I guarantee you this, you'll be more intelligent. Okay, so thanks, Danny. Have a great fall trading season.
You too.
All right.
Take
All
care.
right, buddy. So that's a wrap, everyone. We made it. Have a great weekend. Don't just count your pips, count your blessings. You know the drill. So, yeah, you too, Sinatra. All right, Mark. See you guys. Blessings to everybody. I hope they overrun you like a tidal wave. See everyone next week. Yeah, George. Thanks, buddy.